the line is that investing is the only business I know. I've been doing this a long time. It's the only business I know where things go on sale, everyone runs out of the store. And the cheaper the price, the further they run. And to your point, in every other business, you put something on sale, people will run over each other to get it. But in investing, for whatever reason, when the prices start going down, people run away. And herein lies I think the biggest challenge of investing. Price is a liar. Price has nothing to do with value. The value of any asset is not its price.
Morgan Creek Capital's founder and chief investment officer, Mark Yusko, attributes the recent cryptocurrency price declines to minor turbulence in the summer crypto market, rather than indicating significant problems. According to him, the crypto spring ended in June, and we are now in the early stages of crypto summer, which he expects to continue until after the 2024 halving event. Drawing from previous market patterns, Yusko anticipates occasional short-term price declines but believes the market will eventually recover with higher highs and higher lows. Bitcoin prices dipped following reports that SpaceX, Elon Musk's company, sold its entire Bitcoin holdings of around $373 million. This news resulted in a 10.72% weekly decline, briefly dropping Bitcoin to $24,992 before stabilizing just above $26,000. Ethereum also saw a drop, reaching its lowest price since March 12 at $1,551. Yusko views these price declines as opportunities for savvy investors, as he believes they represent assets being offered at discounted prices. He discusses various aspects of the cryptocurrency market, including the Bitcoin crash, Bitcoin spot ETF, and the forthcoming halving event during a recent interview with BitLab Academy. He emphasizes that the current Bitcoin price is well below its fair value and predicts significant price increases as traders and speculators enter the market shortly before and after the April Bitcoin halving event.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
If you're excited about investing, you're doing it wrong. Right? No, you are. I mean, if you feel really good about things, you're doing it wrong. In fact, it's worse than that. If you make an investment and you feel good about it, you'll probably lose money. If you feel really good about it, you're going to lose a lot of money. If you make an investment and you feel a little sick to your stomach, a little apprehensive, you're probably going to make money. If you feel really sick to your stomach, you make a lot of money. And it's because by the time you and I feel good about it, it's already in the price, right? All the information's in the price. The market has already, and if you feel really good, you're buying something that everybody loves, then you've missed it. And that's why the average individual then rides it over the cliff. It's an interesting dynamic when you think about crypto and why we have this 4-year cycle. And, we're in what I refer to as crypto summer right now. Well, what is crypto summer? Crypto summer is that time where the market has a generally upward drift. It's not dramatic, but slowly upward, higher highs, higher lows, just kind of, like a roller coaster, kind of moving its way up the track. And what causes that? Well, what causes that is investors like myself, I consider myself an investor, have done the work, right? We spend hours and hours and hours looking at the value models and said, okay, the Metcalfe's Law model of Bitcoin, which use Bitcoin as an example, is 55K. Now you can say, well, that number's silly. No, Tim Peterson, my buddy, has this great model. You should have him on the show sometime. He's amazing. And that model's been deadly accurate on the value of the model because any network can be determined, the value of it, based on this Metcalfe's Law and the number of participants in the network. Make a long story short, if the price at 29 is lower than 55, then as an investor, I should want to accumulate. I should want to buy, right? Well, then what happens is as we get toward the halving, that'll happen next, April, and next June we'll shift into crypto fall. In that transition post-halving, crypto fall is where the traders start to come in because we'll start to approach that fair value, and the traders just see movement. Trading is fine, and the good traders come in and they'll actually push the price a little bit, but then you get above fair value. Well, now the speculators come in. And in general, speculators are not even evil, right? What is a speculator? A speculator is just someone who takes the opposite side of a hedger. A hedger is like a producer. An oil producer sells using the futures market. Speculators take the buy, because for every sell, there's a buy. Every buy, there's a sell. That's my favorite thing when people say, "Oh, there's excess buyers in the market." No, there's not. There's
it's exactly equal.
Yeah. Precisely equal.
Yeah.
And there could be on the margin, the next incremental trader could be one or the other, but there will always be an equal number, or the market doesn't work. So then the speculators are there, and they're fine. You know, the miners are selling their coins, and they need to sell more because the block rewards just went down. So the price needs to rise. Well, then the leverage comes in. And when the leverage comes in, speculators turn into gamblers. And the difference between a gambler and an investor is not just where in price relative to value, but also has to do with amount of work. Gamblers don't do any work. I heard that coin's good. I'm in. I find this cycle will get exacerbated and get exaggerated. And then when price exceeds fair value by so much, investors turn around and say, I'm out. I'm going to rebalance, because if I bought it early, now my weighting is really high relative to my anticipated desired weighting. And so I'm going to sell. Well, that triggers the downward momentum. Then the short sellers come in and they push it back down, and then people get margin called, and we get the collapse. But that's when the cycle starts all over.
In the interview, Yusko delves into his perspective on the approval of a spot Bitcoin exchange-traded fund and its potential impact on cryptocurrency prices, especially as the industry approaches the 2024 halving event. He explains that while the approval of one or more spot Bitcoin ETFs could have a positive effect on Bitcoin prices, it might not fully live up to the extensive hype surrounding it. Notably, Forbes reported optimistically that the cryptocurrency market is gearing up for a significant Wall Street shift, estimating it to be worth $15.5 trillion. The article highlights that the SEC is set to make decisions on several spot Bitcoin ETF proposals from asset managers overseeing a combined $15.5 trillion in assets in September. Yusko acknowledges that a spot Bitcoin ETF could attract more institutional investors, including himself, to invest in Bitcoin. However, he offers a cautionary note, suggesting that the reality may not align with the overly optimistic expectations and hype. The interview continues with more insights from Yusko on this topic.
Institutions theoretically are better decision makers than retail individuals. The problem is a lot of institutions suffer the same problem because they're run by small groups of humans. And those groups tend to make equally bad decisions. The pension funds in particular have a long history of being just as bad as individual investors. So I don't know that the institutional money coming in is going to be quite the panacea that everybody thinks. Not all institutions are the same, right? There are long duration investors like endowments, foundations, some pension plans. There are shorter duration institutions. I mean, BlackRock would be that, right? An ETF is not a long-term investor, right? It's a daily liquid, tick-by-tick liquid asset that the institution, BlackRock, doesn't make the decision. It's the masses come in, the masses go out, assets go in. Look at ARK, right? It can go, lots of money can go in, lots of money can come out. Now, the scary thing to me is despite losing more money than she made, more money still going in to that ETF. So I don't really understand that. But the institutions are very varied. And if institutions like Citadel, right, which are the ultimate high frequency traders and day traders, come in, they have a very, they have a fractional of a second hold period versus, Yale might say, I want to hold this for 10 years, or, I might say I want to hold this for a decade in my venture capital fund, which we do. So very different. And the other thing that I think is interesting is this is not new. We've seen this before. GBTC was the perfect analogy. We know what happens when a institution, right? GBTC was a Cayman trust. That is a institutional pool funded with all of this other individual retail money. Now, it couldn't be retail at first because you had to be a qualified purchaser, and then qualified investor, and then you had to buy it in the private markets. But then a year later, you could sell. So then people could trade it in their PA. Well, what happened? We hit the $10,000 fair value, and then we went ballistic. And we went straight up. And everybody's like, oh, that was Michael Saylor and this. No, that was GBTC getting bought every day. Their asset base went from nothing, literally nothing, to I think 20 plus billion at the peak. And the thing about the people forget is when the asset was 200 billion, and 20 billion comes in, you're like, oh, that's not that much. No, it wasn't 200 billion. At least 150 billion of that 200 billion was never going to move. It was the lost or stolen and the stranded and the hodlers and the people who are still accumulating. It was maybe 50 billion of free float, 20 billion on 50. That's going to put some serious pressure. Now we got this again. We got a $500 billion asset, and 100 billion of it is probably the free float. We're talking about 30 billion. If 0.1% of the 30 trillion of assets that are engaged in ETFs, is according to Eric Balkunis, who's an interesting analyst, 30 billion on 100, that'll move the price. But what if he's wrong? What if it's 1%? What if advisors like, I have an advisor and I haven't been allowed because, UBS doesn't allow you to own anything crypto related. When this thing gets approved and it's a BlackRock fund, they're going to have to let it be approved. They're not going to be able to say no longer. And then I'm going to put at least 1%. And if everybody puts 1%, now you're talking 300 billion on 100 billion of free float. That'll move price a lot.
During the interview, the managing director of Morgan Creek Capital also shares his insights regarding potential price manipulation by major Wall Street players, such as BlackRock. According to Yusko, these large financial institutions have been actively engaging in shorting Bitcoin for approximately 2 years, starting with the approval of the first Bitcoin futures ETF in 2021. He goes on to explain that manipulation becomes more feasible when people invest in paper contracts, which are mere representations of the real cryptocurrency and often have minimal impact on actual prices. Yusko contrasts this manipulation with the potential for a spot ETF, emphasizing that it would be more beneficial and less susceptible to manipulation. We would appreciate hearing your thoughts on Yusko's interview. Do you share his belief that we are already in the midst of crypto summer, and that prices will significantly improve upon the approval of a spot Bitcoin ETF? Please feel free to share your comments and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.